For 10 years, one chart told you everything you needed to know about Bitcoin. When governments printed money, Bitcoin went up. Well, the printer is back on. US money supply is growing at its fastest pace in 5 years, and that chart says Bitcoin should be north of $150,000. Instead, it's been stuck at 64K for 6 months. So is the Bitcoin thesis dead? Should you sell it all and buy the S&P 500 like this guy? Or did every printed dollar get captured by the most crowded trade in a generation, while Wall Street stamps AAA ratings on AI debt, the same stamp it put on mortgage bonds in 2007? Meanwhile, underneath it all, Bitcoin has coiled into the tightest trading range in its entire history, with leverage stacked on both sides of the price. Springs wound this tight never stay still for long. A big move is coming, and the only question is which way it breaks. And the answer runs straight through the biggest monetary reorganization in 55 years, happening right now in plain sight. This is Truth Block. I'm Hurley. Let's mine truth. The Bitcoin investment thesis has always been fairly simple on the surface. Bitcoin supply is fixed. Fiat supply is not. So when the world's money supply expands, Bitcoin soaks it up and rises. And for over a decade, that's exactly what happened. The relationship was actually so tight that analysts set their watches to it. Global M2 rises, and Bitcoin follows about 10 weeks later. But around the middle of last year, the correlation started to break. Money supply started climbing to all-time highs, but Bitcoin rolled over. And the two lines have been pulling apart ever since. This is not just a bad month, it's a divergence that's been widening for over a year. Fidelity, one of the largest asset managers on Earth, just published research asking the question straight out. Is the macro case for Bitcoin unraveling? Their answer is that the thesis is still intact, but the plumbing broke. The money is being printed, it just stopped reaching Bitcoin. So where did it all go? Some went to the Treasury, which ran a $432 billion deficit in July alone, up 48% in a year. Some went to gold, where central banks keep stacking aggressively. But the overwhelming share got captured by one trade, and we've covered it a lot on this show. The giant sucking sound of AI. Data centers, chips, power, every spare dollar on Earth got in that line, and Bitcoin got sent to the back. And that vacuum is where this stops being a story about a broken chart and becomes a story about what happens when the thing doing the sucking starts to crack. Jeff Ross sat down with Opti right here on Simply Bitcoin this weekend and walked through the money underneath the AI boom, stage by stage, where it came from, and who's on the hook.
There's a lot of talk right now about this whole AI investment being this kind of circular investment, and we're starting to see weird financial behaviors similar to 2007, 2008, and similar to 1999, 2000, where everyone is talking about these unbelievable revenues that are coming and these orders, like everybody has backlogs of orders that will be paid at some point. And so that's very, for equity investors, that's super encouraging. Like you want to see that. You want to see revenues just increasing and accelerating, going off the charts, and they are, and backlogs just going off the charts, and they are. But at some point, if somebody along this circle can't pay, so like I'm talking about NVIDIA and all of the semiconductor companies, and then all of the hyperscalers that are involved, that they've already burned through all of their free cash flow. And then they've issued, that's step number one. And then step number two is they've issued tons of equity to raise more cash. They've already done all that. Then step three is they've gone to the bond markets and they're taking out hundreds of billions of dollars in loans to the public markets. Step four is now they're getting the sort of the dark markets, the KKRs, the Blackstones, these other institutions that are backstopping their loans now at this point. And this is the kind of stuff you see. And now we're starting to see these loans get put into tranches, similar to what we saw back during 2007, 2008 with this whole mortgage, these mortgage-backed securities, right? And these credit default swaps, these CDOs, these kind of things. This stuff is starting to happen now in the AI sector for the data AI infrastructure build out. The first tranche just got evaluated and was given a AAA rating by, I think, Moody's, which is just exactly the same as what happened back in 2006, 2007, 2008, and we all know how that ended. So at some point, this whole circular financing rush for capital that's happening right now in the AI data center build out, chaos, at some point it's going to run out. So we've seen these unbelievable equity gains so far. Has it already peaked? I don't know. What will happen when the capital runs out and we have the last buyer? It's not going to be good, but things are going to come down. And I think that this whole sector and the backing of the Trump administration has made it too big to fail. So at
Yeah.
some point, stuff is going to start to crumble and it's going to start to look really ugly. And I think it's going to happen pretty quickly this time, like faster than it did back in 2007, 2008. And I think the government is going to be forced to step in and backstop it. And by backstopping, that means, so we all know the phrase, right? These companies, they privatize the gains and they socialize the losses. So when this collapses, it's going to be considered a national disaster and an emergency, and it's going to be a threat to the overall monetary and financial system. So the government will be forced to step in and flood it with cash to save it. And what that means, it's going to debase all Americans and all users of the US dollar to help save it. So they're going to socialize the losses. So they're basically going to be backstopped by the US government, just the way the banks and all the housing industry was backstopped by the government back in 2008, 2009. And all of the regular people paid, right? People lost houses, they got destroyed, they went bankrupt. They didn't get anything out of it, but the bankers got saved. The huge institutions got saved. Everybody who had connections to Washington D.C. was saved, but the regular people gets hosed. That's how you socialize the losses. And I think we're setting up exactly the same way this time. And I don't know when it's going to happen, when the bubble will pop, but it will pop at some point, and that's going to be a bad day.
AAA ratings on bundled tech debt. If that phrase doesn't raise the hair on the back of your neck, go rewatch The Big Short tonight.
And then that happens.
What is that?
That's America's housing market.
And understand what's been riding on top of this. The S&P 500 has been on an absolute tear, all-time high after all-time high in 2026. But strip out all the AI names and the party disappears. The hyperscalers, Nvidia, and its suppliers now make up roughly 30% of the entire index. And 80 million Americans auto-buy that index every paycheck. It's not a sector anymore. It's the National Retirement Plan. Which is why Ross is right about the ending. No government survives letting the retirement system implode on its watch. The build-out is already pre-written, and it's not just Bitcoiners saying so. This week, a gold research firm called Myrmikan published a 20-page letter titled AI Debt Failure Will Prompt Another Wave of Fed Bailouts. The piece doesn't mention Bitcoin once, but it arrives at the same ending anyway. Their exact words, there is only one rule, print or die. So follow the thread. The trade that's been starving Bitcoin for capital ends in a rescue that debases every dollar holder in the world. The vacuum that broke the chart is scheduled to become the fire hose, which means the one move that makes no sense right now is selling the scarcest asset on the planet to raise the very dollars they're preparing to print. And that's why this show is sponsored by Ledn. When life demands dollars, whether it be a tax bill, a roof, or a business expense, you don't have to sell your stack. Ledn lets you borrow up to 50% of your Bitcoin's value, funded to your bank account in under 6 hours, with no credit check, no capital gains event, at roughly half the rate of a credit card. Plus, your Bitcoin stays in secure custody and is never lent out. And Ledn has originated over $11 billion in loans since 2018 without ever losing a single Satoshi of client funds. So head to learn.ledn.io/simply to learn more. Now, zoom out with me because the AI story is unfolding inside something much bigger, and the people running it have stopped hiding it. This past Saturday, August 15th, marked 55 years since Richard Nixon closed the gold window and cut the dollar's last tie to gold. In 1971, they announced the new monetary order on a Sunday night broadcast and promised it was temporary. In 2026, they're announcing the next one in op-eds. And I'm not exaggerating. JD Vance stood up in Munich and called the last 40 years of policy the stupid Washington Consensus. The U.S. Trade Representative went to Davos and cited Alexander Hamilton's 1791 report to Congress by name. Then Treasury Secretary Bessent gave a speech at the New York Economic Club and published a Wall Street Journal op-ed the same day saying it flat out. America is pursuing Hamiltonian economics, which means high tariffs, protected industry, and a neutral reserve asset, the exact opposite of the last 40 years. And right on cue, an old clip of JD Vance surfaced and went viral on X this week, from 2023, before he was vice president, where he said the dollar's reserve status now costs Americans more than it pays. For 50 years, that was unsayable in Washington. Now it's the platform. And just this morning, Scott Bessent posted that the Treasury is now implementing the Genius Act to, quote, cement the role of the US dollar as the world's reserve currency. They keep telling us the plan. So what does that plan do to your money? Luke Gromen went on the Meb Faber show this week and did the math in about 2 minutes. Listen to what he says has to happen and for how long.
Neoliberalism's dead. It's over. We're moving towards Hamiltonian economics. What does that mean? Higher tariffs, more protectionism, higher inflation, higher nominal wages. Okay, that's great, but we've got 120% debt to GDP. We've got 6% fiscal deficits on their way to 7, 8 thanks to this war. We can't afford rates above X. And then you say, okay, well, whatever X is, and it seems to be roughly I've been saying 4.6 to 4.8% on the 10-year. We got the 4.7 again, and boom, Bessent's intervening in markets in a way that Treasury hasn't intervened in 40 years. Okay, that seems like that's still pretty good bogey. How does he intervene? Well, that's ultimately about weakening the dollar. It's ultimately about injecting liquidity. Well, now you're injecting liquidity into an energy, the spike is down, but it's still higher than it was, oil is, than when the war started. It's good for the debasement trade. We've been hearing in the last 3 months the debasement trade's dead. It's not close to dead. The debasement trade, if Hamiltonian economics are being pursued, and we just said across three different administrations, two different leaders, we've pursued the same sort of Hamiltonian policies, then the debasement trade by definition cannot be dead. It has to run for the next 5 to 10 years minimum, because we need to reshore, right? If offshoring all of this stuff to China was disinflationary, which we know it was, by definition, reversing it has to be reflationary. And to me, when you then look at it has to be reflationary. We are continuing this policy across administrations, and we have a debt load that can't afford rates above 4.7 on the 10-year. Real rates have to go lower and lower and lower over the next 5 to 10 years. So as you're looking out next 5 to 10 years, you're looking at a regime where real rates have to keep getting lower secularly, and that implies different things in terms of stocks. It's great for stocks. It's great for business models that are capital hogs like AI, which is pretty much driving GDP right now, certainly on the margin. It's great for gold. It's great for Bitcoin. It's terrible for bonds.
So here's what that means in plain English. Bringing the factories home makes prices rise. That's the policy working as designed. And with debt at 120% of GDP, America can't afford interest rates much above where they sit today. And that leaves one door. Let inflation run hotter than rates for years and quietly melt the debt away. Gromen says 5 to 10 years minimum negative real rates as far as the eye can see. That's the only weather Bitcoin has ever truly rallied in, becoming official policy in everything but name. Now let's talk about the controversial theory, because I know some of you were already thinking it. If you were rebuilding the world's reserve system, would you want Bitcoin screaming to over $200,000 while you did it? Or would you want it quiet, boring, and cheap while you pass favorable legislation, build out the stablecoin rails, stand up a strategic Bitcoin reserve, and let gold reprice first? This is a fun theory and not proven fact, but consider what Gromen laid out the same week. The Allied playbook is to debase together, against gold, against stocks, against everything real, but not against each other, so nothing ever shows up on an FX screen. These are people who are managing how debasement looks. And when you see that, managing when Bitcoin wakes up stops sounding so crazy. Of course, there is another way to read it. Maybe nobody's holding anything down. Maybe the AI vacuum in the Treasury's borrowing needs to simply drink every marginal dollar first. No meeting required. Luckily for us, we don't have to pick. In both stories, the money reaches Bitcoin eventually. And notice how everyone positioning for this holds their assets. Governments vault their own gold. Nobody preparing for a monetary reset holds a paper claim on someone else's promise. Your stack deserves the same standard. And that's why this show is sponsored by BitKey. BitKey is self-custody without the single point of failure. It's multi-sig by default, which means 2 of 3 keys to move your funds. Your phone, the hardware device, and a secured recovery key. There's no seed phrase to hide, protect, or lose, and recovery and inheritance are built right in. The new BitKey even has a screen, so you verify every transaction on the device itself, not just on your phone. The BitKey sale is on right now for 15% off, and my code stacks on top. So visit bitkey.world/truth and use the promo code TRUTH for an additional 10% off the new BitKey. So if the destination is set, the only question left is timing. And the market is telling us something by being this quiet. Bitcoin's trading range has collapsed into the tightest 0.5% of its entire history. No 3% daily move in a month. No 5% move in 72 days. Only 4 other stretches have ever been this compressed. Meanwhile, futures open interest is back near all-time highs, roughly 750,000 Bitcoin of leveraged bets, while trading volume falls off a cliff. James Check sees liquidation clusters stacked on both sides. Longs get flushed near 60K, shorts get squeezed all the way up to 67K. This is record leverage pressing on record thin liquidity. And when this resolves, it resolves violently, and possibly in both directions before it picks one. And I owe you the honest downside first because Ross gave it too. If the AI unwind arrives as a full crisis, Bitcoin gets sold first. It's the most liquid asset on Earth, and a margin call doesn't let you choose what to sell. March 2020 cut Bitcoin in half in days. Then it tripled within a year, because the response to every crisis is the same response. But just look at where we're coiled. Bitcoin is sitting at around $64,000, a hair above the 200-week moving average. The line it's only spent real time beneath 4 times in 17 years. And every one of those windows minted buyers who never looked back. And underneath the flat price, Adam Livingston just documented the largest ownership handoff in Bitcoin's history. Old whales distributed their ancient coins near $100,000, new hands absorbed them, and today's price sits barely 19% above the whole network's average cost basis. So the froth is gone. The coins are aging into stronger hands. That sure looks like a floor being poured. Which brings me to this poor soul. A guy on Reddit, all in on Bitcoin since February, announcing he's selling 10% of his stack every month to buy the S&P 500 at its all-time high. No dunking here, I understand. 6 flat months breaks people. But walk his trade with me. He's selling the scarcest asset on Earth at the network's cost basis to buy an index that is 1/3 AI names being financed like 2007 mortgages at $7,800, right as the bailout memos are being written. And let's not forget, priced in Bitcoin, the S&P 500 is down 97% over 12 years. And Billy Boone just ran the brutal math on timing. If you'd bought the exact top of all 4 Bitcoin cycles, the literal worst entries in history, you'd still be up 22% today. Time in Bitcoin forgave the worst buys ever made. What it never forgives is the early exit. And in my experience, most people don't capitulate because their thesis broke. They capitulate because they're carrying it alone. No plan, no security setup they trust, nobody to sanity check the fear at month 6 of a flat chart. And that's why this show is sponsored by the Bitcoin Way. The Bitcoin Way offers one-on-one white glove counsel from real human Bitcoin experts. Anything from self-custody setup and running your own node, to locking down your security, and even inheritance planning so that people you love can actually receive what you built. No question is too basic for the Bitcoin Way. So visit thebitcoinway.com/Hurley, and your first 30-minute consultation is completely free. So let's close the loop on that broken chart. Everyone reads it as Bitcoin failing to respond to money printing. Flip it. The chart is measuring pressure. For over a year, the printer has been filling a reservoir, and the AI trade is the dam holding every dollar upstream. Jeff Ross just showed you the cracks in that dam, and they're stamped AAA. Groman just showed you the water level has to keep rising for 5 to 10 more years. That's math, not opinion. And Washington is replumbing the entire river while the water sits low, exactly the way you'd want it if you were them. The M2 chart isn't telling you what Bitcoin is doing. It's telling you what Bitcoin is owed. And pressure like this never releases slowly. But now I want to hear from you. What's actually holding Bitcoin at 64K? The AI vacuum soaking up every dollar? Or something more deliberate while the monetary order gets rebuilt? Is selling Bitcoin for the S&P 500 at this stage of the AI trade the purest bottom signal there is? And when the M2 catch-up finally comes, does it come slowly or all at once? Drop your thoughts in the comments below. And if this gave you signal, don't forget to hit the like button and share it with a friend who's eyeing the S&P. And subscribe to Simply Bitcoin for more signal every single day. I'm Hurley. This is Truth Block. Thanks for hanging with me, and I'll see you on Thursday.